All right, good evening, guys. Ken at Tortoise Capital with the nightly strategy podcast for 31st of July, 2020. So we're doing the daily report and also the weekend report. I only received one question from the hybrid workshop, guys, so I'm going to close the door on the hybrid workshop and start consolidating those notes and putting it into a tighter format. But I'm going to start converting the Saturday morning webinars to a new course on systems thinking, and so I'll be starting to roll that out tomorrow. And I'll still answer hybrid frog questions, but I'll do that during the nightly podcast. I'll continue to post them in the Basecamp in the usual way, but the Saturday morning focus is going to shift to systems thinking and probably a summary of the weekly events or something like that. I've got 3 or 4 additional courses I want to get to, and I feel like getting to the point of diminishing returns on the hybrid workshop. So to breathe some new life into the Saturday morning podcasts. Okay. So Milt's question was on asking for clarity on when to move to no lose plus dinner for 2. And we covered that quite a bit over the last 2 or 3 weeks, I think, with the Wu Wei exit and the kata. Those are 2 different ways in which that can be done. Bill Scheidt is putting together a research project looking at hybrid trading with 3 different forms of entry. He's got another variation of mine, so we're going to get a systematic look at the difference between the kata exit, the Wu Wei exit, and the other one that he's developing, and we'll put that out as part of the annual research weekend. But as it stands right now, for me, the best starting place is the Wu Wei exit, and that is that you make the initial stop at for the supported spring crossing. You put that initial stop at the PSAR, and then just hold it there until the PSAR dots themselves move, I'm going to say 3 dots above your entry. That creates a little cushion, which should equate to the no lose plus dinner for 2. Then, like a sniper would, you just move that static stop up to that level, and then hold that there until the Bollinger Band mean gets above that line, and then you just pick up the Bollinger Band mean exit. In the case of where you were already well above the Bollinger Band mean, or it's so far above, like on a supported fall crossing, you might use the PSAR instead of the Bollinger Band mean. But generally speaking, for the supported spring crossing, you just had a harsh winter, and so that Wu Wei exit will get you to no lose plus dinner for 2 in a mechanical way. It removes all discretion, so there's no cognitive cost of doing that. And then the Bollinger Band mean gives us plenty of buffer or room to grow. So you're letting a winning position unfold correctly, and then it takes a move against the Bollinger Band mean to kick you out. So that would be my recommendation to simplify the cognitive load there. Okay. All right. Let's shift into a little market health check here. So this is the 10-day look at a glance. And what I've marked out here are the for this 10-day period. We entered the 10-day at about 321.50. It climbed north to the 10-day high 3 days later, at 327.30-ish. It sold off to the 10-day low at about 319.30, and then over the next 6 days, it has ground its way back up to vicinity, very near that 10-day high and 30-day high, and closed very strongly in that 10-day range at 326.52. Now, I want to notice that along the way there was a trader's opportunity in here where yesterday that market sold off sharply all the way down to the 10-day low, and then in the second half of the day plus today's final climb, it made that recovery. So although it feels like this was just a buy on dip kind of a week, it actually looks more like this, and so you get a different feel when you incorporate some of those extreme volatile days of the last 2 days. Today's recovery was led almost exclusively by tech, and without the big four, Apple, Amazon, Google, Facebook, and probably throw Microsoft in there too. Today looks very, very different, but that's what the S&P looks like. They're being pulled by the four horsemen of technology. So let's take a look at some of the other dimensions we have here. The 10-day range was about only 2.5% wide from the high of the 10-day to the low of the 10-day. That's only about 2.5%. So slightly less than two ATRs. And the distance from the 10-day high to today's price is only like 0.25%. So for all practical purposes, we are knocking on the door. And then to the upside, now that we notice that we closed outside of Z1, outside of the dragon itself is still sloping up powerfully. Today we recovered from that dip below the PSAR, so that remains intact. This is an example, by the way, of why I do that PSAR on the RL10, because that is more directed to the price trend as opposed to the short-term technical or tactical anomalies. So we didn't get a PSAR flip in here because we're using the RL10 to feed the data. If we were using price data, then there'd have been a couple PSAR flips in here, and we'd get a really disjointed set of signals. So one of the things that you get by using the RL10 is you have to live with the cognitive dissonance sometimes of the price being below the PSAR and it hasn't flipped yet, and you need to at least appreciate why that happens. Frank asked a question in the chat there on it. The stop is put slightly behind the Bollinger. No, it's right at the Bollinger Band mean. Don't try to overthink that. If you feel tempted that if the Bollinger Band mean feels too close, then just use Z-1. So, and then stick to whichever one of those you want to use. In indexes, I prefer the Bollinger Band mean all the time. Sometimes in a very volatile symbol, let's say like Kodak or Virgin Galactic or something, that the Z-1 is legit also if you want to give it a little more room to run. But 90% of the time you'll find the Bollinger Band mean is sufficient. What you get with trading indexes, for example, is you're trading off some of that sharp bar by bar volatility for the smoother, almost like ocean waves that you get from a blended instrument like an index. Okay, so back to the show here. So the that 10-day range is only about 2.5 percentage points. The dragon remains solidly up, and you'll notice that his little His little slope is up, following that orange line. The dragon extension is positive. The PSAR extension remains positive. So today's PSAR was 321.40. And so we can project forward that it'll be 322.50 on Monday. That's where the PSAR dot will be, just following that extension. The RL30, on the other hand, has been uniformly strong and passed all the way through our 10-day period, departed up here. And when we look at the extension, it's still solidly up, pointing towards Z2. The RL90, which had peaked here and then started to rotate down, actually is now starting to roll back up. It got flat and then actually going up a little bit. So the RL90 in green is benefiting from the upward trend basically of the last 5 or 6 days. And so the RL90 looks like took a pause and is then going to continue. So that's a very healthy condition. So the upside is really kind of unbounded. Once it gets through this 10-day high and 30-day high, there's really nothing in here that's going to act as resistance, at least until we get up to 331 and the Z2 line. Then it just becomes statistically stretched. But if we take a look at today's price action as sort of a standard day, that's like a directional day's worth of, looks just like that, and you add that to Friday's close, that's what a 1-day strong upward move is going to look like. It could easily get up to 331.50. To the downside, I'll just clone that rascal. It takes a directional day to get back down to test the low of the day. Then if we get a second one of those, what does it break? It could get all the way down here back to the Bollinger Band mean. That would be a fall from 326 to 316. So that would be about a 3% move. That would be almost 3 ATRs. So that buffer that's built in to the downside for protection is pretty strong right now. So this is a market that is still against all odds, in my view, voting northward. So let's take a look at the support levels that we would see on the way down. It would be the peak of the dragon at 325, the spine of the dragon, and the RL10 price, which is right here, and the Z1, all in here at about 324. So that's really strong support right there. Bottom skin of the dragon at 323. The PSAR at call it 322, and then Monday that's going to be 322.50, almost 323. The low of the day, 321.50. I think that's got to hold for this really to keep that upward narrative going. Then the 10-day low remains here at 319.50. Then there's really no resistance whatsoever, or no support whatsoever in here until the Bollinger Band mean at 316.5, and then we would see Z1. It's just off the chart down here, like around 310-ish. So this is now going into the weekend with that strong of a day, led by tech. I think you can be optimistic about the large cap techs in the short run. But when we look at the other things that happened today, not so much. The narrow strength that was in the market today is noticeable. So that's what we'll look at next here. So I want to take a look now at what worked today. I'm going to try a slightly different technique, if I may. Okay, so first thing, oh, I thought that was going to keep working for me. Sorry, just a minute. Okay, first things first. We'll take a look at this was the zero line today. So everything above this thick red line made money today. Everything below that red line lost money today. So let's find the S&P was right here at zero point 0.8. And now I want to compare it to the other indices for the U.S. So the S&P led the way at zero point 0.8. The Dow was next at zero point 0.4. Then the Russell was disappointingly in the negative territory at minus 0.95. So the large caps got pulled north by tech, and that was about it today. Um, the sectors. So again, if this thin red line is the S&P, the only sector that was better was technology XLK at 2.5. Then you'll notice all the tech leaders that were responsible for that performance just dominated today. So XLK was 2.5. That's about 80 different companies in the S&P technology sector. But the real leaders were the QQQs leaders, right? So you got Apple at plus 10.5, Facebook at 8. The triple leveraged sector was 7.8. The triple NASDAQ 100 was 5.4. Amazon 3.7. Yeah, he needed that boost. So you can see it was really those symbols there were pulling tech north, and then that's what pulled the S&P north. All of the other sectors underperformed the S&P today. So the next best one was consumer discretionary at 0.52. Then materials, XLB, was 0.10, so basically flat for the day. What's important about that is that even though materials were up 0.1, our individual companies that we follow, like Alcoa was minus 1.37, Nucor was minus 1.76, Cliff and Cliff and U.S. Steel both got smashed, minus 8.5, minus 9.5. So the steelmakers really got slaughtered today. The non-steel materials guys broke even, but steel really got smashed. So discretionary 0.5, materials 0.1, finance basically 0.04. Then in the red, then the next best is energy at minus 0.5, healthcare minus 0.6, Mexico minus 1.2, clean energy minus 1.5, Brazil minus 2.55. So a real disappointment in the broad markets, and then in the derivative markets, Mexico and Brazil. Not very good. The other thing that did really well today was a resumption in the precious metals. So they've had like a 4-day sell-off, and silver was up 4%, and wheat and precious metals basically 3%. Now there was an anomaly in the energy sector. So the energy sector was bad. It was down here at minus 0.5, but Devon Energy was up 1.45. The double inverse energy was up 1.4, but Devon Energy was better than that. So that Devon Energy had real buying pressure as an individual company today. So that's the takeaways I have for today. Kodak, I wrote a little bit about that on Patreon, was down 27% today. 27%. So while we're here, just let me just talk about that. So I want to start with the bigger picture. So on the big picture, what you have here at the blue arrow is the day before the news event occurred that they were going to get a $800 million loan to start producing pharmaceuticals domestically. So they're going to shift and become a pharmaceutical manufacturer, which is not out of line with what their skills are as an industrial company. But the point is that the news event occurred after the close of the blue circle, and then there was this big gap up. So it closed somewhere around 3.5, and then opened at 10, and then had some volume and follow through. It was after this anomaly, and then compare that to the horror show that was Kodak all the way up until that point, averaging 80,000 shares a day, and now suddenly 1.5 million shares trade in here. This was the day after the news, and then this got the Robinhood traders' attention, and then they did this, ran it to 60, and then sold off with 20 different times that trading was stopped because of the volatility. And then from 60, it's done nothing but get smashed. What you can't see on this chart, because of the size of this scale, is you can't see the price anomaly on the day just before the announcement occurred. I'll point out that 125,000 Robinhood traders did this, and then that happened to them. So 125,000 Robinhood users got to experience this. So where does their money come from? Unemployment, stimulus checks, money that was borrowed from them and their children, loaned back to them at interest, and then with nothing to do but speculate, ends up doing this. That would be the running of the herd, the madness of crowds. There's a reason why the phrase is getting hooked. The same way you put bait that's tasty and delicious to a fish, and a sharp iron hook, and then you hook them. So I'll just psychologically, what's the bait that attracts you to act against all your rules but makes you want to do that? If you had a feeling that you wanted to participate in that, or some other runaway freight train that you hadn't prepared, you should notice those feelings and notice what the bait is that's attracting you. And then when do you bite? How do you make your decision on when to go for it on a speculative play? At what level of risk? So the point I want to make on this chart is that the price bump on Monday, which was prior to the Monday night announcement, is invisible on this chart because of this scale. But when you go look at Monday, this is this is Monday. So Monday picks up right here and then does nothing but get further slaughtered in the same way that it had for weeks and months prior. And then Monday, for some reason, on massive volume, there's just a ton of buying interest. And look at all the green bars over here. It tells you every trade that was taken where they're just paying whatever the seller is asking, or all hitting the ask. I'm sorry, not hitting the bid, hitting the ask. So they're paying the asking price if it's in the green. That would be an indicator of a a urgency to buy at any price. Only those price levels where there's red is where there was volume exchanged, where the seller came down and met the bid. So on the basis of no news and nothing announced Monday morning, just after a long weekend in which that had happened, all of a sudden there's a ton of buying interest that takes it from $2 to 270 on 30 times the normal volume, 20 times. So Thursday and Friday, it traded about 80,000 shares and 1.6 million shares traded on Monday for no apparent reason. And then after the market closed, they announced, oh yeah, there's going to be this huge loan being given to Kodak, and we're going to prop them up with as much money as needed to make pharmaceuticals. And do you think the government and Medicare will be buying that just to make sure they're a success? You would be correct. So call that 2 million shares. I call it 1.5 million shares that went from 3 to 10 the next day. That's $7. You know, there's 10 million bucks made right there. And then the next day it goes to 60. So that's $100 million of insider trading. And nobody's going to investigate that. That's criminal activity. There will be plenty of outrage about this sell-off saying, oh, the poor Robin Hood traders, and who's protecting the little guy? And that you would think would scream for regulation, but that won't happen because retail trades fund the trading desks at market makers and big banks because they can see your bid and they can see your trade, and then they can take the middle piece and arbitrage that. That's free money to them. So that's not going to get regulated anytime soon. But that's just now. Tesla and Facebook are more refined versions of this with a slightly different underlying hook. Tesla isn't making any money, but they are leveraging two things: government preferred funds and getting away with accounting shenanigans that make their numbers look better than they are. Facebook was propped up and funded by government money, which was looking for a market solution to gathering background information on everybody in the United States. And so both of those are receiving government blessings. The government's picking winners and losers, and that's just a more refined version of this Kodak shenanigans. I'm wondering how long it'll take the Democrats to start calling for a special prosecutor. I guess they have to check to see who among them made money on this. The Kodak CEO said, gee, I mean, we did a pretty good job of not letting the secret out, but we knew for a couple weeks that this was going to happen. And he made a couple $100 million on insider purchases that he's been making over the last couple of months. So we'll see how long that lasts. All right, back to our regularly scheduled program. So in summary, this is my look at what happened today, that although this looks good on paper, and we're going to see how it looks good on paper for the indexes to close very strongly for this week, that's almost exclusively to those top 4 or 5 tech leaders that are such a large part of the market that they pulled the whole market north while everything else just got smoked. And so that is not a recipe for success. That's what happens when the music stops. Okay. I want to just go to, I just want to go to the weekend report now, I think. Actually, some of the guys made some very good moves today. I'm just really tickled pink. Here's Luke with 3.3 in Brazil. Nicely done. So he's got the hybrid frog entry. He moves to no lose plus dinner for 2 after about 5 minutes. Then just picks up the Bollinger Band mean, Wu Wei exit. Takes the exit here. He was waiting for the RLXD to break, I guess, and otherwise I would think this would be your normal exit here. But still, that's a really good exit. The second trade was short. Oh, I'm sorry, you did get out there. I misread that. My bad. This was short, and then a quick snuffing that out. Then a supported spring crossing in the usual way here, and 1.7 for a nice net of 3.3. Well done. This is I can't remember who got this one. Oh, Dave. Oh, yeah. So Dave got a basically the same hybrid frog. Got a second position on a collapsing dragon in here, and then made a nice, collected a nice trade here. And this is Brazil, I think. Yeah, this is Brazil. And then basically a scratch on the supported spring. So this was about 2.4 in here. Well done. Is afternoon trade, I think, or is this the morning? Oh, this is the morning trade on XLK. Plays the supported spring. It takes a reasonable entry there to just lock in. If that's the first trade of the day and want to get paid, I don't disagree with that. There was he identified a possible entry here for future study. Yeah, especially when you look at it crossing the VWAP, that's a nice place to re-enter, but that's all right. Because now later in the afternoon, he plays the supported spring, crushes it, gets a second position in, and sniper exit to lock it in, and collects, I think he said 6.5, and really good markup and good discussion all the way through. I think this was a nice way to capture that. I like the dotted green line is showing the maximum favorable excursions. So well done on that. So that's 9R done in the usual way. I just want to recognize good work when I see it. Well done, fellas. Yeah, Van points out there's another $1 trillion to spend, and that's going to go funneling through in the usual way. I posted a couple charts in the chat room tonight. That's what I'm going to be lecturing on tomorrow. So I've got 2 big projects going on right now. One with the true storytellers and ethical leadership, and then one with the University of Chicago Business School. We're taking a look at the intersection between civilian and military decision making under conditions of uncertainty, and what can civilians learn from military. So I'm laying out sort of the the different processes of standard work that we use. You guys are going to be familiar with that because so much of that has infiltrated into how we trade. But I'm trying to help their faculty and some international thinkers get a grip on all that. And it's intellectually stimulating to me and allows me to think about what we're doing and to add some rigor to it. So I'll lecture on those two tomorrow if you want to download them and look at them. That has to do with how do you decide how to model and how much to test and how to rehearse and what to do with the creative impulses that you get about the markets. How do you systematically study them and then exploit them? So the usual stuff. Let's see, that was yesterday. Let me get today's report up here. Darn it, someone had it open. So this is already posted on Patreon, and it's in the handout section here if you want to get your copy. I will be posting the the registration link for the nightly podcasts later tonight in Patreon after we get through this one. I got to schedule the next month out. And let's see. Okay, let's go. Okay, so is that correct? Yeah, here we go. The weekend report for August 1st tomorrow. So we are still in bullish normal conditions with today's very strong close. We are strongly overbought on every dimension. Every dimension is above 90. Too good to last. We are 5.25% above sideways. The ADX is still weak at 13.4, so we haven't fully gotten traction yet. ATR has declined to 1.27%. It was twice that 3 weeks ago. The risk Z, which is the 30-period moving average of the VIX divided by the 10, is at 1.126, so it's still favoring long side swings. And the Z-score at 1.08, still slightly abnormally strong and favorable. So the Monday rebalancing for the monthly core portfolio strategy, depending on which of the ETF portfolios you analyze, you can see it's all tech all the time, large caps. So tech, emerging markets, and large caps for ETF 13. ETF 22, it's tech, and consumer discretionary. In ETF 32, it is Wheaton, clean energy, and tech. You're up 35% if you're following ETF 32 because of the contribution of those two guys over the last 2 months. And so they remain in the portfolio going forward. And then these are the current leaders going in of the other categories. So Apple, Microsoft, Home Depot, Procter, and Walmart, silver, clean energy, gold, and then the other two. ETF2 theoretical exposure still at 100%. On the monthly, so we've now, with this very strong close, today, basically, today really made the month and nudged it just into a new high up at Z1. There's still some distance to go from the RL10 up to the PSAR, so this is still cautiously optimistic, but we're within spitting distance of 340 now. That's a 5% move now to the all-time high. I still feel this is vulnerable because of the very narrow strength. It's all located in those top 5 or 10 tech companies. The monthly moves are getting smaller, so that means it's getting harder and harder. The S&P weekly, today's strong close brought it back up to last week's high, and it's right on that boundary at Z1, ready to break out. We said if it can break through here, then halfway up is the all-time high, and then a full Z move up to 355. So that's, I think it would take 2 steps to get up there. On the downside, the 2-week low, the edge of the dragon, spine and belly of the dragon, and the Bollinger Band mean, everything is above 300, but that's the area, in my view, you want to preserve. I think the weekly baby dragon and that upper skin of the dragon is how much room I'm giving it, like 318. That's where I'm putting my stop. I'm going to keep as much of this third leg up as I can. I'm going to give it about $8, which is about 2 ATRs. PSAR still just marching along nicely. Weekly, we've already seen the daily. The 30-minute, this is one of the reasons that I am just a little hesitant about Monday. Is you notice that this big run up in that last 30 minutes. So this is the 30-minute check. So today it went fall, winter, and then the summer, and then it had this runaway move. If you take a look at all the other closing runaway moves, this one was followed by a big sell-off. And that was that's a 2% sell-off. This big run-up was followed by a big sell-off. This nice run-up had a sell-off. This run-up had a big sell-off. So after every extreme push up vicinity Z3, and this is near Z3, there's been a sharp profit taking the next day. Here's one. Here's another one. Here's one. Here's one. So the fact that this closed so strongly going into the weekend, a scenario would be, that makes everybody feel good and safe that comes home and sees it, the end of day data. And so they pile in because they just got confirmation of a breakout on Monday, and you get a nice big gap up, and then they crush it back to the VWAP. The VWAP is down here at 323, and this is up at 326. So that's a 1% exaggerated move in the last 30 minutes. So to me, that's very vulnerable. That entire stack is very vulnerable, and the VWAP feels more natural and normal. So I didn't chase that. I'm not holding it over the weekend. But there you are. Shifting to the comparison of those 4 different markets, sort of a representative markets, if you will. So we just saw the weekly, and why I said this, the 2-week low is, for me, is key, as it's already testing this, the peak price here. Tech is clearly the one that won, because as you look at this, you see that it's already exceeded the previous peak. So this is all excess gains. Whereas Brazil is still only halfway up the stack and sold off today. It did not push any higher. So Brazil is feeling a little more vulnerable even than tech in the U.S. So Brazil looks especially vulnerable. Treasuries, on the other hand, are in a position to benefit. If we saw weakness in the S&P and weakness in tech, then that money, if it were looking to cycle somewhere safe, um, treasuries is a pretty good place. And this is very close to breaking out of the peak of the RL10 at 172. So if I can get above 172, it can get to 180 pretty easily. So this still feels solid and safe to me. ETF 32 or ETF 2 portfolios are up next. So the things that really worked well, all tech all the time, just crushing it, and that's about it. The people were buying real estate from an oversold basis, but the previous surge in Latin America seems to have peaked. And let's see, where's Brazil? Looking for Brazil in my stack here. Oh, it's in 32. Yeah. So it's just tech and plenty of weakness everywhere else. ETF 22, it's either form of tech. And notice the tech sector, XLK, was a little better than the Qs. And that leads you to TECL rather than TQQQ if you're looking for the triple leveraged. The short-term pops that we've seen in emerging markets and materials both got punched in the face this week, as did Latin America, Eurasia, Japan, and energy. So just energy is just as bad as it can be, which makes that move in Devon energy today all the more interesting. Real estate and utilities, that's some defensive sector buying right here. While they're cheap, people are buying, some smart money is buying, well, I guess they'd call themselves smart. I guess I just did too. Real estate and utilities, the defensive plays, are making some money in here. And so did treasuries at up 1.12. While the market felt really good, it was up 1%. Treasuries are up 1.1. Just saying. ETF 32. So this adds a few more symbols in here. I think Wheaton gave an opportunity to buy extreme strength on sale, and if there's any weakness in the U.S. markets, it stands to reason Wheaton has potential. Clean energy is a long-term play, and it's going to be based on trying to get an alternative to the international energy and petrodollar leaders. And Democrats have been showing a willingness to pick winners in clean energy and green energy deals. So as a sector, PBW is starting, I think, to factor in Democratic victories in the House and the Senate. And so PBW is on my strategic radar for that reason. Tech and gold, the two, and then where's my silver in here? Yeah, silver is represented by Wheaton in this case. Agriculture, real estate, and utilities, the world of real things. That looks to me like defensive buying. Inside the Dow, I want you to notice on this one, winners win, losers lose, as a rule of thumb, not as a 100% fail safe, but Those losers kept losing big this week. So U.S. Steel and Chevron, wow. Boeing, just all that free money's done. Pfizer looks like it still has more room to go to me. But Procter & Gamble, just a clear winner. Apple, I've been beating that drum. And I think Microsoft has more room to catch up. But Microsoft and Home Depot are still some opportunity plays inside there. You might be interested in Danny's options trade frame on Walgreens. He's done a nice job at the over at the options course website, and he's just built a couple, two or three new TC2000 layouts strictly for options players that are aligned with his course, and he's really doing well with that. I got to tell you, I'm really impressed with his work. In the sector spiders, the broad sector spiders, again, defensive plays, real estate, utility, plus big tech for immediate gratification, and innovative technologies again. Again, this one on the ETF Max is looking at like 300 of the symbols, and really anything in this area, anything that was in the green on the blend, and then also in the white. So social media, that's kind of a Facebook and some others. Even China making a comeback in here. China tech, and tech, all over the place. So that's a global phenomenon. In the world market model itself, I start off by looking at the U.S. market. So this is tech, that's QQQ. So tech, all of the growth we're winning and the value plays we're losing. So it's all tech all the time. You notice among the top 10 indexes on the regional summary, it's only tech is really dominating, head and shoulders above everything else. The U.S. is better than Euro-Asia. Two weakest sectors, Japan and the Euro-Asia mix. Energy just getting crushed, tech dominating, and then consumer discretionary in a clear second place for doing well. In the ETF2, no surprise here, silver, gold. Home construction is a bit of a surprise to me. Then again, all kinds of tech and things that are starting to lose a little bit. So white and green, and that's the S&P Growth Index, and even consumer discretionary. These are starting to slow down. So white and green was great, now just good. So you want to preserve profits, watch for a resumption, but don't let that get away from you. So this is sort of the broader sector is starting to lose focus and lose energy, while the tech leaders are really starting to are still the ones that retain the value. Okay, we'll shift to the daily. Let this come up on your screen. And again, what I'm going to do on Sunday is review any trade frames that you like to post in the chat room by, let's say, by 3 o'clock on Sunday. Any of the charts that you post in the chat room for me to review, I'll comment on those Sunday night. All right, so no signals on channeling and overreaction. Yeah, no signals, channeling and overreaction. EFA has joined the list of possible weak areas. It was just Asia less Japan and Latin America. Now the Euro-Asia blend is starting to suffer. I'm wondering if that's a function of the U.S. starting to shift away from the alliance with Germany, and the strengthening of ties between Germany and Russia over energy. And so the U.S. is posturing military forces and economic aid to Poland, Estonia, Latvia, Lithuania, and sort of moving away from old NATO and more towards the Baltics. That's just as dumb as it can be. Yeah, so the winners in Max Payne, these are all your candidates for strength, relative strength, and relative weakness remains Intel, Boeing, Chevron, 3M, Goldman, and all of those frame out pretty well. Intel continued to be a big loser today. That was a layup for those that you've been following the Intel trade. I did not hold that short as a swing over the weekend. I want to go into the Monday fresh, but Intel remains 9-1, and it's now a 5DD, but it was a doji, and so that got me out because that would be sort of the perfect setup for getting a swing long next week. And you can see it's just been crushed in each of the time periods. Still plenty to choose from in terms of the auto framers. I'm not going to read all those to you. RSI 2, whenever that's less than 10, these are all like 2-day washouts that all look favorable. So Intel and Boeing are both in that category. But even Walmart is showing an opportunity. Walmart has the additional advantage, though, being a triple screen, so it's a strong sector that has just pulled back, whereas Intel is the weak member who is also a 5DD. But now you also got 5DDs on the combination of hamburgers and Coke, so McDonald's and Coca-Cola showing as 5DDs, so I would be on those. In the ETF tactical summary, just one doji today in oil, and then just a handful of symbols that test out well. Of interest to me would be XLB, because I'm always interested in them, but now there's an extra reason. He's got a 2-to-1 auto framer, so XLB. XLE is 2.8-to-1, so maybe he's oversold. And then oil exploration at 2.2. So those are all three favorable on a swing term basis. So if we see some uptick, that would be how I get started on what could be a nice swing trade in those. Meanwhile, silver just knocking it out of the park on every time frame and up 4% today. Harder to manipulate silver than gold. That's why I like trading silver. Auto framer. Again, lots to choose from. There's all the stats on Intel for those of you that wanted to set up just mechanical trades. And there's some great names on that list. Intel, Goldman, 3M, Chevron, the energy sector, the oil exploration sector, and XLB. So those were those three favorable ones we just saw in the ETF summary. So that's all the mechanical frame data for you. On the deeply discounted ones, Intel, GE, JP Morgan, Johnson and Johnson. And then these are all your relative strength leaders. The most ATRs above their RL270. That's all your key leaders. I like the fact that McDonald's is a relative strength leader, 4 ATRs above his fair value, but also has a momentary pullback that makes him favorable at 2.5 to 1 in the sector. So that's a strong up, a measured pullback, and plenty of room to the upside on a reentry. So McDonald's is definitely one that I'm going to frame this weekend. Yeah, Betty makes a note. She got long-term options on silver and Wheaton today, and both got her in the money. Well done. That's good insurance. On the daily squeezes, there's Goldman and XOP. So these are all symbols that had relatively narrow ranges today. And if there's just a normal mechanical breakout, that can give you a nice one-day pop. So that's the size of the potential move on a one-day pop. So I like those. Still on the Four Seasons, still a very mixed bag between those in the fall and those in the summer. All the ones in the summer are the ones that have been showing greater strength than their counterparts. The falls are all the ones that are showing some potential pullbacks to support levels, and that makes the Qs very interesting right there because they're at minus 1.73 on the Z-score, meaning that the pullback was significant. Now the room to the upside on resumption is very favorable. So that's how I read that. Plenty to choose from on that chart. Last one we'll look at now is the so many things have suffered weakness today that only the techs, in this case Merck, but Apple, Microsoft, and Cisco were the big winners today. But look at the broad array of names that suffered. And again, it was the winners, the leaders that are doing well, that did well today. The things that have been suffering just got much worse. So that's more of the haves and the have-nots. You'll see the same thing over here on the ETFs. The Qs, XLY, tech, and the S&P on the strength of tech. But Brazil broke, Mexico broke, Latin America broke. That's an area of low risk, short side trades if the market gets weak starting next week. All right, so that's everything I want to cover today. I will do the start the new course tomorrow, the systems thinking, and then Sunday night's workshop will be on the taking a look at trade frames that you guys have posted. Okay, so that's everything I got. You guys take good care, and we will see you this weekend. And Eugene, I'll see you in the morning. We're going to be posting the owl feathers in the sacred soccer grove, 10th Avenue Soccer Park, to overwatch all our activities. So I appreciate you're doing this, and more than I can say. And we'll see you guys in the chat room.